9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching the China Show. I'm Yvonne. We're counting down the open of markets in Greater China. Our top stories this morning. Asian stocks trading cautiously as investors rein in risk ahead of the release of the key U.S. data, including that November jobs report. And China's weak economic numbers prompting a debate on its policy path next year. State media playing up Xi Jinping's call to boost domestic demand and warning against chasing, quote, reckless GDP expansion. Also ahead, China Vanke sweetens the terms of its request to delay a bond payment after creditors rejected its initial proposal. And President Trump says a deal to end Russia's war in Ukraine is closer than ever as Washington offers more security guarantees to Kyiv. Well, happy Tuesday morning to you. Of course, we are still tracking the last full trading week of 2025, and we're still talking about things a bit in the back foot here. We're going to talk about stocks, bonds, as well as the dollar has been losing steam of late, and you continue that for a second day here in Asia. Take a look at what's going on in the Nikkei and the Kospi. We're seeing declines of more than 1%. Taiwan is coming online, and we are also seeing that same amount of pressure on some of these sort of tech-heavy benchmarks here this morning. So that AI trade still very much in question. Traders, though, basically are on hold. If you take a look at how the bond market is doing, leads to run up to this whole November jobs report coming out in the U.S. So it is a bit stale. There is some concern about data quality, given this is kind of a catch up from that government shutdown. But this is certainly the first sort of relevant and relatively current sort of set of data since that government shutdown. So that is going to be taking center stage here as well. The bond market has been pretty range bound of late, though. You still see that U.S. 10-year yield just slightly higher, about 4.16% as well. But that dollar weakness does persist. We continue to see that when it comes to the greenback here. Take a look at dollar yen. We're still seeing that strength here and breaking below that 155 handle right now. I think you have the likes of Nomura saying that Tankan survey yesterday, basically was a nail in the coffin here, that perhaps Japanese companies are now ready for that BOJ hike. If you add that to some of the wage data that we've seen of late as well. That really kind of adds to the case whether this November jobs report is going to change the whole narrative here, whether the Fed can continue to ease in 2026. Gold, we're halting sort of this 5-day rally so far. We're steady when it comes to gold as well as silver here. Also checking copper prices, given the run up that we've seen, pretty steady here so far. It's really been Bitcoin that continues to have that sort of bearish turn, right? We're sliding deeper into bear market here and breaking below 86,000, which is perhaps the lowest level we've seen in about 2 weeks as well. So that certainly is going to be something that leads to maybe more of a bearish signal for markets here right now. Because, given when even other markets have rebounded, Bitcoin has not. So we'll continue to watch, of course, how that correlation does fare. Overnight in China, though, we take a look at how the ADRs and some of these tech plays in the U.S. played out. It was not pretty, right? Golden Dragon China index was down about 2% there. That's the biggest move we've seen to downside here in about 3 weeks or so. You saw that in the Crane shares, some of these ETFs in the U.S., and you saw really big moves to the downside for Baidu, Alibaba as well. We'll see how that bodes for the China market here today, but likely to see a bit of pressure here. Take a look at see when it comes to futures. We're lower by about 1/10% here right now. Chinese 10-year yields at 185. But yes, in the face of all that, you still have a stronger renminbi, right? So breaking below 705 certainly is quite significant in the face of this dollar weakness. But again, there's a lot of debate. A rare debate, really, on the currency and really how strong policymakers are willing to let it go. So that's going to be one thing in our agenda here today, that yuan strength, whether it persists as well. Of course, the fixings of late have been sort of, strong, and then maybe halting some of the strength that we've seen in the currency. We do have a listing debut here in Hong Kong today. We're talking about Guoxia Technology. Also, Vanke, right? We're talking about our sources telling us they've added a bit of sort of details on how to sweeten this deal after, of course, bondholders there failed or at least did not approve didn't get that 90% approval last week. Rare earth stocks could be quite moving here today, I guess, or quite influential, given that interview that we did with the European Commission saying that they have seen China start granting some of these licenses for rare earths. We'll bring you that interview throughout the show here. Of course, we're going to wrap up the day with some jobs data out of Hong Kong. But really what's been going on is we're still kind of digesting what people are calling a pretty ugly November data dump that we saw yesterday out of China. And you're starting to see that be reflected in some of the state media and what we're seeing that's dominating the news coverage of late, right? And you're hearing it from the top. President Xi and his call to boost consumption is in focus today. Really a day after that, we saw that activity data showed the economy remained under pressure. This is from the party's journal, Qiu Shi, and other state-run papers published speeches that the president made over the past decade on this very subject. And she is quoted as saying that boosting domestic demand is a strategic move. Let's get more now from our China correspondent, Min Lo, who's been kind of deciphering all these sort of comments from the president. And what is it telling you?
Yeah, I think, first of all, the timing is very interesting. Coming on the day just right after we got the ugly November data, as you said, retail sales was at the weakest that we had seen since COVID. Fixed asset investment were set for the first annual decline since 1998. And state media now saying that they are publishing this set of speeches or paragraphs and quotes of what Xi has said about boosting domestic demand over the past 10 years. And it shows you that China has been looking at boosting domestic demand for a long time. And there are a couple of things I want to point out that I think bears reminding. One is that he said back in 2016, he said demand side management emphasizes short-term adjustments, regulating taxes, fiscal and monetary policy, but supply-side management addresses the structural issues, the long-term issues. And in another year, he said that boosting domestic demand is not about boosting government spending, he says. It's about institutional arrangements to change or to guide consumption, investment, and savings. And I think what this tells you is that, first of all, China has been thinking about boosting domestic demand for the past 10 years. It's a long-term goal. It's not necessarily something that they want to boost urgently at the expense of more spending and more debt. It's all about structural reform, supply-side reform, boosting private investment. And I think this could maybe quell some of the concerns or speculations as to why China has not shown any signals that is going to put out bold short-term stimulus.
Yeah, it's all about that rebalancing. When it comes to chasing this sort of reckless, he called it reckless GDP expansion. He talked a lot about the overinvestment that we might be seeing in very certain crowded sort of industries.
Yes.
What more did he say about that?
Yeah, this is also interesting because he actually made the speech back during the Central Economic Work Conference, but It's only just being released now by state media. And I think it's surprising because the language was very sharp and direct. And he talked about how officials shouldn't be recklessly spending and that the government is going to clamp down on vanity projects that are meant to bolster a politician's resume. He said that the assessment of how well a politician has performed should not be just based on short-term GDP growth, but how solid a foundation they have laid down for long-term sustainability and people's livelihoods. And he gave some examples of wrongdoings, including excessively large development zones, exhibitions that are seeing disorderly expansion. He talked about fake construction starts, inflated statistics as well. And he said basically China needs to embark on real and genuine growth that is not exaggerated. And he noted the decline in fixed asset investment, and he urged officials to remain calm, not to make wasteful investments that would lead to a project being abandoned as soon as they are completed. And I think it tells you two things. One is that the government is more cautious about their spending, right? Especially given that they have just made some progress around tackling the hidden government debt. And number two, I think China is also giving more signals that it's prepared to lower its targets on growth, right? It's willing to sacrifice the quantity of growth for better quality growth.
All right, Min, thank you. Min Lo, our China correspondent, really helping us break down what this all means. And we did a little bit, certainly it did move markets in some ways, right? Take a look at how the strength of the currency is one thing we're tracking. Consumer names also were actually moving in some ways in the face of some of these comments as well. Another story that we're tracking, of course, this morning is traders are looking ahead to the U.S. data due later, which includes November's jobs report, right? Let's bring in our executive editor for Asian markets, Paul Dobson. He joins us from Singapore. Paul, before I get to the jobs report, what we've been talking about in China has been, the economy is not firing on all cylinders as we count down to 2025, and it could make for a pretty challenging 2026. And the market seems to be somewhat sensitive to that sort of headline now. Are we in for more weakness in these Chinese markets now?
I don't think that that's a foregone conclusion, Yvonne, because I do think that the market really likes the growth stories that we have within China in terms of tech, in terms of AI, in terms of infrastructure build out as well. And that's been, kind of helping us stay on side despite the weakness in the domestic economy. Also, exports have been holding up relatively well, albeit coming under some pressure in the second half of the year, but much better than we would have feared when it was in April time and we were talking about the big tariffs and then that ratcheting of tensions with the US. In fact, actually, the relations with the US seem to be in a little bit of a truce at the moment. So that's another positive for the market. So I think that domestic demand picture is almost a secondary consideration when you have those other things going on in the background. And the market tends to have a pretty positive slant, particularly on mainland stocks at the moment, but on the Chinese market overall. So I think, yes, there's going to be some bumpy patches, the US session overnight, for example, but the general the feeling behind everything is that there's still a little bit of a sense of optimism. And I think if you combine that with continuing yuan appreciation, which it seems to be, on a very steady path higher at the moment, then maybe that points to a more optimistic framing for markets than there is for the economic data.
Yeah, I mean, it's interesting. I love that story that, you guys laid out about it's basically they're facing all these calls of a very sort of rare debate about the currency and how strong it has to be to help with this sort of transition and rebalancing of the economy to boost the domestic demand picture. What are you hearing in terms of, the tolerance that policymakers have for a stronger renminbi?
That's right. It seems that there's definitely a debate out there about how much further to let it go. I mean, remember this year, yes, the yuan is stronger against the dollar, but overall on a sort of basket basis, it's still weaker and particularly weaker against the euro, which is where a lot of the Chinese exports have been headed this year. And Europe isn't going to stand for that forever. Probably they're going to, continue to ratchet up the rhetoric, pushing back against too much Chinese imports because it's hurting European industry. So I think that tension is one thing that will allow China to continue to let the yuan appreciate. But on the other hand, and I think that this is the really interesting sort of longer term argument, is in order for China to make that jump, actually for consumption to grow, they need a stronger yuan. So it discourages everything being thrown into the export basket, everything being, put into the idea of, well, this is the easiest way for us to make money. We'll just keep making things that we can sell to the rest of the world. Rather, stronger currency means that they can import more stuff and maybe the consumer feels a little bit more confident about buying, and that juices the economy as well. So that's one of the considerations that policymakers are really weighing at the moment as they consider whether to allow for a greater yuan appreciation next year. Some strategists are calling for some pretty big gains. I was reading a note from Stephen Chen, for example, overnight, looking for it going all the way down into the mid-60s over the next year, which I think is, a pretty impressive. I think he was calling a 12% gain, something like that, against the US dollar, which would be, pretty pronounced, a little bit surprising. But obviously, it's not going to be a very rapid or one-way move because of the way that the market is controlled. More likely that kind of continual steady appreciation that we've been seeing for the past few months.
Yeah, and as we look ahead, Paul, the market seems to be just on hold until we get these November U.S. jobs data figures that come out later on tonight in Asia. How much merit should we put in trading these numbers, given the fact that there is a bit of a lag? There was a lot of concerns about whether they can actually retroactively collect some of the data as well.
Yeah, we don't have anything better to go on. That's the problem, isn't it, Yvonne? And the Fed, to be clear, is very worried about the labour market. We've seen that in comments from Jerome Powell himself. We've seen it from various other members of the Governing Council. This is the consideration that they're weighing at the moment. How rapidly is the labour market deteriorating and how much do they need to cut rates to kind of accommodate that and offset it as well? We've seen 3 insurance cuts, as they've been calling it, over the past quarter. There's gotten interest rates down somewhat. Now they want to wait for the data to catch up to figure out exactly where we are in terms of that labour market outlook. This data, according to analyst forecasts, would show still a pretty depressed picture, but no rapid deterioration or anything that would sort of cause the kind of panic that would trigger more rate cuts automatically. But on the flip side of that, even Powell himself has said maybe the data aren't very reliable at the moment. Maybe they're miscounting or overestimating what the jobs picture looks like. And if you take that into consideration, if we do have a duff number, then maybe the market will get excited about the prospect of more interest rate cuts into the new year.
Paul, great to have you. Paul Dobson there joining us out of Singapore on what to watch out for, of course, in the next few hours when it comes to that jobs report. Coming up next, though, we'll discuss the outlook for the Fed with UBP after Governor Stephen Miron says underlying U.S. inflation is close to the central bank's target. Anitza Nip is joining us in the next part of this break, or after this break. We're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is the China Show. Futures slightly lower this morning.
There was a large bout of inflation that resulted in an increase in prices after the pandemic. While American families are still rightly distraught with that experience and unhappy with affordability, prices are now once again stable, albeit at higher levels. Policy should reflect that.
That was Stephen Miron, Fed governor, arguing for, of course, a quicker pace of policy easing by the central bank. He was one of the, of course, dissents in that last meeting, calling for 50 basis points of cuts here. Let's bring Anitza Nip here, head of fixed income research Asia at UPP. She's been talking about how busy fixed income markets have been all year for you. As we wrap up, though, you know, we finally had that Fed rate cut. It seems like there's still so much debate on whether they can continue to cut for next year. Do you think you've gotten much clarity on what next year looks like now?
Well, I guess, Fed would still need to look at, the data. We reckon the labor market is still, a little bit weak. So we'll see, what's the number comes out tonight. Basically, we think that in 2026, it's going to bring the terminal rate to around 3%. That means that potentially could have two cuts. Treasury is for the 10-year, the curve has dipped quite a bit, but we reckon the 10 years could be in the range of 3.75 to 4.25 because we are still in the, rate easing cycle.
So is it likely going to stay range bound, you think, in these levels?
Well, we reckon that it, would probably, stay around that range. Short end could be impacted by, number of rate cuts. Yeah. At the moment, a lot of things have been factored in, including how many times. Market seems to be factoring in around one time. But I guess, that would really depending on the data. So that's why going forward for fixed income need to manage the duration because the long end is still subject to a lot of volatility, including, for example, the fiscal budget, deficit and things like that. Yeah.
How are you looking at the inflation picture, right? Obviously we still see the U.S. inflation has been above its target for some time. It's proven to be quite sticky, and we haven't really quite felt the effects of tariffs just yet. Is there a concern that we're going to see a ramp up in inflation next year?
Well, in fact, for our house view, they reckon the inflation could be, slowing down, sort of steady going into 2026. It could probably reach around 2.5, around that area. So that's why it won't, be a major factor for the Fed, sort of consider. It would be a factor, but, not a major. But I think they're concerned more on the labor market itself.
Okay. And the fact that the Fed is easing, but the rest of the world seems to be signaling at least that they might be done.
Correct.
When it comes with their easing cycles. How does that change the dynamics in any way? Does it just only reinforce the dollar weakness and really benefit this part of the world? Yeah,
this is a good question because, Fed probably would cut again. So that's why at the moment I think US dollar would still be weakened. But I think the pace of weakness would not be as big as this year. It would be sort of a modest weakness. So that's why, for example, people could look out for some other opportunity in the fixed income in non-US dollar space. For example, like Aussie or maybe, like CNH as well. We also reckon the CNH would appreciate as well. So that's why it could be something they can look at. But I think majority of the market for the investor are still looking at dollar market.
They are still looking at dollar market.
Yes, definitely. Because I think the choices outside of US dollar is not, as much as what the people can, choose. People are still looking at dollar, as the major currencies at the moment for fixed income investment.
Tell us about the strength of the currency, though. It seems like we've seen a bit of a pushback from the strength of late, but why would you suggest that maybe we could see more appreciation in the currency moving forward?
You mean the renminbi? Okay, the main reason would be next year they are going to focus on a lot consumptions. They also in a trade surplus as well. So that could also lead to the appreciation of the renminbi. Our range we are looking at would be around 6.85 to 7.05, that particular range. I mean, at the moment, it's not too deviate from the upper end, right? Yeah. 7.05. But I think slowly, gradually, the government may, let it appreciate a bit. I think 7 definitely, would be the first point. Yeah.
Okay. In terms of just the PBOC has sort of buying bonds again. I mean, how do you see that inflecting the curve or changing the curve in any way? And what pace do you think that they could actually buy bonds?
I think everything they would just do it quite gradually.
Yeah.
The curve itself, I think, it won't affect a lot in terms of steepening. I think it would sort of like, stay in range bound. At the end of the day, they want really, a stable sort of also government bond yield, such that, it can help a lot in terms of financing and everything. Yeah. But of course, they also need to build the long end of the curve where, people would have opportunity to invest into.
You mentioned about, we were just talking the break about Vanke, about, it might just be an idiosyncratic sort of event here right now.
Yeah.
Why do you think it won't be some sort of, spillover effects? Because, there's some that have argued that if it does default, it could be something worse than what we saw with Country Garden or with Evergrande too.
Yeah. When we look at the Chinese property market, the restructuring or like these kind of problem has been going on for 3 years, right? A lot of them have already restructured. And, there's only a few survivors at the moment. For this particular case, we reckon that because a lot of negative news has been built into the credit market, we reckon, it would be an idiosyncratic risk. We just don't particularly think that it would impact a lot on the Asia credit space in general, or even the Chinese credit. Because when you look at the number of issuance this year, actually picked up quite a bit on Chinese credit.
Yeah.
For example, SOE, some of the corporates, some of the banks as well. So overall, we don't particularly think that would be a big impact. People would just put it as a single case.
Okay. Anitza, it's great to have you. Happy New Year. Anitza Nip there, Head of Fixed Income Research for Asia at UBP. Particularly when it comes to your reference rate here as well, it is actually a weaker one compared to what the estimates were calling for. 706.02 against the dollar here. The estimate was for a 704.95 print. So maybe there is more sense of the PBOC trying to at least slow the appreciation that we've seen of late after, of course, breaking below that 705 handle there. We'll have plenty more coming up. This is Bloomberg. All right, pre-market is looking like this here right now, slightly under pressure, but yes, going against the grain is this listing debut today, Guosha Technology. We're up 89%. This is a company that talks about, they do renewable energy products, smart energy storage. Certainly is the buzzword of this day, given this whole AI trade. So certainly a stellar debut there for Guosha. We'll have your market open coming up next. This is Bloomberg. Welcome back. You're watching the China Show. We're counting down the open of markets here in Hong Kong and in China. And right now we are seeing slight pressure when it comes to what the Hang Seng is looking like right now. But relatively speaking, the rest of the region seems to be feeling a bit more of the chill across risk assets. When you look at Taiwan, you look at Japan, you look at Korea here today, are all seeing pretty deep sell-offs here. So in the face of it, Hong Kong looks to be a little bit more resilient here right now. A lot of that might have to do with the strength of the currency at 704. These are fresh 2025 highs for your onshore and offshore rate here of late. So that dollar weakness certainly is reinforcing that, obviously, and also these Xi comments that we got from the last 10 years talking about boosting domestic demand did actually move some of the markets here, whether it was the currency, even some of these consumption plays here as well, at a time when the AI trade is seeing a bit of wobbliness of late here. There you go. Your onshore markets are online, and we're seeing the CSI 300 down about 1/5% here this morning. We're watching copper. A little bit of pullback there. Of course, we're watching very closely how gold and silver are playing out here. Still steady as we count down to that November jobs report out of the U.S. here today. But, certainly there's going to be a lot of focus on the whole consumption plays given these Xi comments that were released in terms of the timing, quite interestingly enough, a day after that November activity data where, a lot of the economists are saying was a pretty soft print across the board. Retail sales, the weakest print we saw since the pandemic, right? So this rebalancing of the economy seems to be back in focus here today. Let's see how the Hong Kong markets are doing here. Looks like we're down about 0.5% on your Hang Seng. We're trading around that 25,500 level here. Keep in mind, of course, we're tracking what the tech space is doing and really kind of following through what we saw with some of the ADRs in the U.S. session overnight with Alibaba and Baidu were both down substantially. We're down about 1% or more for both of those stocks there. Tencent looking a little bit better, Meituan as well. So it seems like Alibaba, one of the bigger drags here today, with HS Tech lower by about 0.6%. Not a whole lot of catalysts out there really as we count down here. We talked about this as the last full trading day of 2025. But really standing out is, of course, a listing debut, Guoxia Technology. So they talk about renewable energy, energy storage and the like. There you go. 93% pop there. Not too bad on this Tuesday morning, and really going against the grain with most of the sectors here this morning. And we're also watching when it comes to rare earth stocks as well, where there is some sort of movement. It seems like slightly lower here. We did hear from the EU about how China is starting to grant some of these general licenses when it comes to these critical minerals. So maybe signs that China is trying to at least strike a good tone with its allies here when it comes to the issue of rare earths and trade. For more on these Chinese markets, let's bring in Lianting Tu, our managing editor for Asia Equities. And really, we talk about the lack of catalysts, Lianting, but it seems like the market is still very much focused on that weak data print that we got yesterday.
Yeah, it is really about the growing pessimism that we're seeing over the Chinese equities again. And if you look at milestones, we're looking at MSCI China Index and the Hang Seng China Enterprises Index, both are very close to entering a correction. And if you look at the Hang Seng Tech Index, it's almost at bear market level. So we're seeing a rapid deterioration in investor sentiment over Chinese stocks. If you look at this month to date, December, HSCEI is ranked at the second worst performer in the world. As you said, the weak data print definitely played a role, but also there's a lack of fresh stimulus. And there was a big story yesterday about how China's focusing more on the quality of growth. So that is sending a strong signal to investors that the growth is going to be pretty much at 5% level. There's going to be very limited upside surprise. And second thing to watch out for is really people are trying to lock in the winners, the profit from the winners of this year. HSCEI still did well year to date. I think we're still looking at 23% gains or something like that. And right now, basically, because of the lack of stimulus, people are just cashing out.
Yeah, I mean, take a look at this chart. We talked about what we're seeing when it comes to 8 shares, right? We're hanging on, or at least, by a thread when it comes to that 200-day moving average. And this, as we start to see, right, the macro data start to worsen. And really for much of this year, Lianting, it seemed like investors are willing to see through the macro picture and really kind of focus on these AI trades. Why do you think that there's a change in that dynamic now?
Yeah, I think right now, because the data has deteriorated, if you look at yesterday's data dump, none of the data point was good. A lot of people described it as very ugly set of data. So that kind of ugliness really now is grabbing attention. And of course, with Vanke's crisis, now property is again at the front and center of people's mind. And the recent action from the Shenzhen government shows that the government support will be less or maybe non-existent. So overall, that kind of sentiment all of a sudden resurfaced for investors. And plus, the backdrop for global equities is in AI enthusiasm is fading. So that's definitely not helping.
Lianting, thank you. Our managing editor for Asia Equities, Lianting Tu, joining us out of Singapore. So we talked about, against all those narratives there and the negative headlines and the like, we're still seeing some pretty upbeat sort of listing debuts, right? Guoxia Technology is certainly one of them, surging about 97% here right now. And it really has, against this backdrop of Hong Kong and its world-beating IPO market, and is really still ending the year on a strong note. The financial hub is set for a flurry of deals that would make December the busiest month for listings since 2021. For more, let's bring in our Bloomberg Equity Capital Markets reporter, Dave Sebastian. So tell us what's happening in Hong Kong. I'm sure you've been busy too, Dave.
Exactly. It's been a very busy year for everyone, for bankers, and especially us here at Bloomberg as well. It's been a very busy year because Hong Kong share sales have been raising more than $73 billion so far this year. And that basically marks the first time in 12 years that Hong Kong is at the top of Asia's fundraising market, just below the U.S. globally, really. And that's been a result of these jumbo deals like CATL's $5.3 billion listing back in May. and that's like the world's second largest listing this year. And it's such stark contrast compared to the years past when Chinese stocks were in the troughs. So we're really seeing this rebound this year, and it's been seen so far this month where these companies are rushing to market to seize this final window to list their shares this year.
Yeah, and how's the rest of Asia looking too?
The rest of Asia is also equally frenetic because 4 of the world's 5 top fundraising hubs are in Asia. So we've got Hong Kong, mainland China, India, and Japan. These are the top it's 4 of the 5 world's largest markets for share sales so far this year.
And what are they expecting for next year? Can we continue on this sort of momentum?
So the Hong Kong Exchange has said that there are roughly 300 companies waiting to list, and these include long-dormant IPOs like Syngenta Group, for example, and CK Hutch's Watson, and these deals could raise billions of dollars next year. So the pipeline is really deep, but how those pan out next year, that's subject to the stock market, broadly, just the stock market generally, as well as other black swan events that we can't really predict. But overall, the mood is still very, very positive, and bankers are at least expecting the next 6 months to be visible on their end.
Yeah. The bankers going to be happy, I'm guessing, for this year. Dave's going to keep busy. Even in the face of being busy, you've been able to still win some competitions, internally here in Bloomberg. It's interesting. We had this charts of the, I guess, what's it called? Bloomberg Charts competition that
Charts
we just
competition,
had.
yes.
And you won. And it was on something about the IPO market. Can you tell us a bit more? We're firing up right now.
Sure. So I made this chart back in August or July when we had our big take about just how vibrant Hong Kong's market has been. And this is just to show that Hong Kong's IPO market as well as stock market, really has been increasingly been buttressed by mainland Chinese companies. And this has been evident through the deals that have come to market this year, which are second listings of big Chinese companies that have been listed onshore, like CATL and also others like Hengrui, for example. And these deals have raised billions of dollars this year and led to a 4-year high in the IPO market.
Dave, congratulations on that, winning that, our contest here. Just to let our viewers know, what did you win? It was like a T-shirt.
It was a T-shirt with that chart on the T-shirt. So.
Okay, I expect you to come on air to wear it next time. Dave Sebastian there, Equity Capital Markets reporter. On the latest on the IPO market here in Hong Kong. We talked about that list just now of the upcoming ones in the pipeline, right? There's another company that's going to be listing in Hong Kong, and we're talking about Hashkey Holdings here. Its shares will debut on Wednesday. We'll be hearing from the CEO himself, Xiao Feng, right here on the China Show. You can catch that interview on the Times on your screen. This is Bloomberg. All right, obviously a lot of focus when it comes to rare earths here this morning, where we're hearing from the EU's top trade official saying that China has started granting longer-term licenses that allow European companies to access critical minerals needed for industries, including clean tech, automakers, and defense contractors. You're seeing a decline here across the board from some of these rare earth stocks here. Speaking exclusively to Bloomberg, Maroš Šefčovič also discussed ongoing negotiations with the U.S. over steel and aluminum tariffs.
What unites us is that we really need to take care of overcapacities which are destroying, the steel production in the U.S. but also in the EU. And I explain again that we adopted these very far-reaching safeguards if it comes to the imports of steel from the third countries to the EU, which are kind of very much reflecting the measures which U.S. has undertaken several months ago. And therefore, I suggested again, let's go back to the idea where we can kind of build this ring of friends, where we would trade on MFN, or zero levels, and we would have the same, let's say, measures to take on the global overcapacities. The situation as it stays right now is that I sent to Secretary Latning the list of the codes where we believe that we can definitely lower the tariffs. I understand there is some interest, especially from the machinery sector, but we didn't proceed or haven't proceeded yet to the very concrete negotiations on this type. So we're talking on the level of teams. We are almost, I would say, in permanent contact with my counterparts, and I think this would be good for both sides, because if America wants to reindustrialize, they need machines. We produce the machines. We are ready to send them the machines, but of course we need to find a solution on the derivatives.
And speaking of sort of rare earth minerals, this obviously has been thrust into the sort of the conversation in a very sort of obvious way now by the China. Are we getting closer? Is Europe getting closer to getting a general license from China as the United States has?
Yes, I think that there I can say that we are in a very close contacts with Foreign Trade Minister Wang Wentao and also his team, so we are communicating on different levels. We had here the team from China specializing on export controls like a couple of weeks ago, and I think we are getting initial reports from our industry that they are getting these general licenses, but we need to have a little bit more granular information to evaluate the whole process. But the fact that this idea was favorably received, that it seems that we are getting first general licenses, and also that the Chinese side was receptive to our arguments that the process as it was set up in April required too much of I would say, very intrusive information, too many photographs, too much detail about the supply chains, and I think that the general licensing could be one of the solutions how to address this issue.
European Commissioner for Trade Maroš Šefčovič there speaking to Bloomberg's Oliver Crook. Now, staying on trade, the UK has also finalized a trade deal with South Korea that London says will boost exports to the Asian market. Now, this agreement comes just weeks before an earlier deal was set to expire. The UK says the deal will grow its services exports by more than $500 million as firms get improved access to Korea's financial market. And turning to Hong Kong now, and President Trump says he feels, quote, badly about Jimmy Lai's conviction in the financial hub. The former media mogul was found guilty on Monday in a landmark national security case.
I feel so badly. I spoke to President Xi about it, and I asked to consider his release. He's not well. He's an older man and he's not well, so I did put that request out. We'll see what happens.
Let's bring in Alan Wong, our China economy and government editor. He's with us here right now to talk about the response that we have seen from the Western world from this case. Is it likely going to become a bigger topic when Xi and Trump meet next year?
That's really hard to assess, but we've just heard from Trump saying that he brought it up in a previous meeting with President Xi. But the manner in which it was brought up, it was not Trump saying that he demanded his release or explicitly making it a central demand in any trade negotiation with China. He said that he just brought up the age and health of Jimmy Lai. So it's unclear just how hard Trump would be pushing it in his upcoming talks with President Xi next year. And we've also heard from the UK. I mean, the UK summoned the Chinese ambassador to complain about the verdict and, again, asked for his release. And then China, in response, also protested this because Beijing has long objected to any form of foreign intervention.
What comes next? I mean, obviously, we have to talk about the sentencing for Jimmy Lai, but what is next for Jimmy Lai?
So next month, in mid-January, the court will hear the mitigation for Jimmy Lai, which means that his family and friends and people who support him will show up in court to talk about why he deserves a more lenient sentence. So sentencing might come days or weeks after that. Because Trump's visit to China is scheduled for April, so there should be, that sentencing should come before that meeting with Xi.
And I guess, is there any sort of message, do you think, that this case is really sending to the world right now?
I think the outcome, well, the fact that he was convicted of the offenses wasn't surprising to many people. This case has been years in the making, and then the Chinese government and the Hong Kong authorities in different occasions have shown how much they dislike Jimmy Lai and how they see him as a threat to national security. And in the immediate aftermath, you've also seen very strong rhetoric from Chinese and Beijing and Hong Kong authorities that Lai polluted the minds of a generation of young people, and that he's seen as a traitor of the nation. So over the years, we've known that to be the case, and this verdict just confirmed that his actions are seen as offensive in the eyes of the law as well.
Ellen, thank you. Ellen Wong there, our China economy and government editor. Some other stories that we're turning to now. President Trump is suing the BBC for $5 billion over a misleading edit in a documentary last year. Now, that gave the impression he had made a direct call for violence in a speech leading up to the January 6, 2021 attack on the U.S. Capitol. The BBC has since apologized for the edit and had earlier rejected Trump's demand for compensation. Meanwhile, Trump is classifying fentanyl as a weapon of mass destruction in his latest push to ramp up pressure on Latin America over drug trafficking. Trump allies say such a move can open up access to funds appropriated for detecting and eliminating weapons of mass destruction. The president says he's also considering an executive order for federal agencies to reclassify marijuana as a less dangerous drug.
That's why today I'm taking one more step to protect Americans from the scourge of deadly fentanyl flooding into our country. With this historic executive order I will sign today, we're formally classifying fentanyl as a weapon of mass destruction, which is what it is.
Is it accurate that you are considering an executive order to reclassify marijuana under the control?
We are considering that, yeah.
Are you planning?
Because a lot of people want to see it, the reclassification, because it leads to tremendous amounts of research that can't be done unless you reclassify. So we are looking at that very strongly.
All right, let's take a look at markets here right now. It seems like the sell-off is accelerating here in Hong Kong. We're seeing 1% losses here for Hang Seng as well as MSCI China. What's really kind of dragging that is the tech space. Once again, we're down about 1.5%. HS Tech now we're treading around that 5,400 level. So we'll see if we actually break below that here today. But it seems like right now continued downside when it comes to the tech trade here today. Asia Pacific is also down by 1%. We continue to see their losses in Japan. Kospi also seems like those losses are accelerating now. We're down close to 2% there in Seoul. This is Bloomberg. Some stories that we're following for you today. Nasdaq is looking for a regulatory approval to extend trading hours on its stock venues to 23 hours during the work week. According to a filing, the firm asked the U.S. Securities and Exchange Commission for permission to add an additional trading session. This could take effect in the third quarter of 2026, pending regulatory approval. PayPal has applied to become a bank in the U.S., looking to take advantage of the Trump administration's openness to fintech companies entering the banking system. The payments firm says that if approved, the PayPal Bank would help strengthen its small business lending capabilities. And this comes after a number of cryptocurrency firms, including Circle, Ripple, and Paxos, recently gained preliminary approval to become banks. JP Morgan and the U.S. government are backing Korea Zinc's planned smelter in Tennessee, which will supply critical minerals essential for chip making, defense, and aerospace. Construction is expected to begin next year, with commercial operations starting in 2029. The deal is part of Washington's efforts to establish domestic supply chains for key minerals. Bloomberg has learned that Japan's Mitsubishi UFJ is nearing a deal to acquire a minority stake in India's Shriram Finance, which focuses on vehicle loans. Now, sources say MUFJ may invest over $3.2 billion for a 20% stake. Japan's largest banks are investing in Indian financial institutions, betting on the country's growth there. All right, we're checking movers here this morning. Jiangxi Copper is one that seems to be trading to the upside here. Citi there with a massive sort of revision in terms of the price target for that, raised it by 40% to 47.9 yuan there. They're talking about on the higher metal prices that they're betting on, whether it's copper and gold there. So the stock is up 0.8% here right now. We're also tracking when it comes to Chang'an Auto, I believe. We'll see if that one actually is there. But certainly there was this approval approval from the likes of Chang'an Auto, the likes of BAC, getting these permits for L3, level 3 driverless cars. Chang'an Auto was moving quite substantially here. There you go. We're up about close to 4% there right now. So this is the first permits granted, according to CCTV, for those level 3 driverless cars. You take a look at what the rest of the markets are doing. Those are probably the bright spots there. The rest of, in terms of the benchmarks, are doing this here right now. So you are seeing onshore markets are lower, but Hong Kong seems to be seeing a deeper sell-off. And the renminbi, though, they're still holding on, clinging on to that strength there, despite there was a pretty weaker fix there from the PBOC here today. But we're halting at least some of the strength here today. But we're still at a fresh 2025 high for the offshore rate here this morning. And you take a look at when it comes to the rest of the markets. Obviously, we're still waiting for this November U.S. jobs data as well, whether that is, warranted in terms of how you trade this time, given the fact that there is a bit of a lag. But nevertheless, risk assets are on offer here today. Welcome back to the China Show. Here's a look at the HSI a half hour into the session. And we are, of course, in session lows here right now. We're down about 1.5% for your 8-share market. Hang Seng is down 1.3%. HS Tech, we talked about it as well. We are getting closer to, of course, correction territory. We look at how the MSCI China is looking like here this morning. So we'll definitely mark that. But right now, we are seeing down 10% from the highs that we saw in October 2nd for MSCI China. So certainly it is a down arrow story across the board, but in China in particular, I think it really has come down to what has been the soft November activity data print that we saw. You pair that with some of the president's comments here about really trying to boost domestic demand and the timing of this release from comments that date back from 10 years ago. This whole rebalancing sort of effort is certainly what has been the key focus, and perhaps that might mean less stimulus for next year. That seems to be what the market is clinging on to here today. That's why you are seeing more declines here. We're extending further here into a second day as we count down, of course, to 2025 and the last full trading week for the year. And this is how the rest of Asia is doing as well. Of course, as we also have to count down the November jobs report coming out of the U.S. as well. So we're also seeing losses about more than 1% across the board in Japan, in Korea, as well as in Taiwan here today. So the AI trade is on offer, and that certainly is leading to a lot of questions about, how much more can the Fed can really cut next year. That seems to be that lingering debate that continues on here as well. And whether, the November jobs report is going to be quite telling here in terms of whether we can settle that debate is certainly going to be the key question. But dollar continues to be on the weaker side of things. You take a look at dollar yen, and that strength continues here. And we've broken below that 155 level here for dollar yen now. And Nomura was the one that talked about in that Tankan survey, really kind of solidified the case for the BOJ to hike at the end of this week. So that certainly is why the dollar yen is at these levels here. We're pretty much range bound when it comes to the Treasury market here. We're on hold until we get some picture of what this jobs report is going to look like here. 50,000 jobs gains is the estimate there with a 4.5% employment rate. It does suggest maybe the labor market is deteriorating, but not falling off a cliff. That might add to the narrative that the Fed cuts can continue for 2026. That certainly is going to be the case here. And what we're going to be focusing on and really taking center stage is going to be that jobs report. I want to bring in my co-anchor for this hour, Annabelle Droulers. She's been so gracious to step in from Sydney there. Belle, how you doing?
Yeah, I'm going well. Nice to be here in Sydney, of course. But market action today, as you're saying, is really dominated by those expectations around the Fed and what we're going to get from that jobs data later as well. It's going to be an interesting report because, of course, you've got still the effects of the government shutdown are feeding through into the October data in particular. But, it really seems like that case is set for easing, and particularly as we get a new Fed chair into next year as well. But let's take a look at the markets now with our MLive executive editor, Mark Cudmore, joining us from Singapore. And Mark, Yvonne was just outlining there just the level of caution we're seeing among investors today. Is that warranted, do you think? It seems like that stage really isn't set for a Santa Claus rally into year end.
I definitely don't think we're going to have a Santa Claus rally this year. I think that the structural backdrop going to 2026 is still very positive. We've got the Fed easing, even though the economy is holding up okay. We've got an administration determined to juice kind of asset gains into the midterms. We're still at the inflation stage of the AI capex bubble. Earnings are holding up okay. So generally, everything is pointing to 2026 being a good year for stocks, at least, the first half of the year. We should see stocks make fresh records globally. But I don't think we're ready to kind of get in that rally yet. This is something I've talked about probably for the last 6 weeks. I think it's going to remain difficult into the new year. And part of that is that we're seeing a drift higher in yields. And we've still got the crypto fallout, which is weighing on retail sentiment at the margin. It's weighing on that enthusiasm to kind of really get invested when you can see that the crypto sector is still suffering. The digital asset treasury companies are blowing up or slowly kind of imploding at the margin. So I think it's going to be difficult for another couple of weeks, and probably in mid-January we'll kind of get enthusiastic on the bigger structural backdrop.
How much do we need to worry as well about the AI bubble story and the anecdotes we continue to get? For instance, Oracle needing to push out the construction timeline for the OpenAI data centers. Is that still feeding into the narrative? Do you think that AI bubble concern, or do you think, to your point, it's more shifted to things like the crypto story or Fed outlook for next year?
So AI has been the most dominant theme of this year. Despite all the policies that we've got out of the US administration, it's actually been really about the AI theme, which is why we've seen global stocks continue to kind of surge. And there's definitely a massive AI bubble, and it will, at some point it'll burst horribly. But it's important to identify what the bubble is. It's a capex bubble, and that leads to some stock prices getting overinflated. But it's not generally a broader asset price bubble. It's a very targeted in terms of the asset prices. And that is what's driving the economy. And the reason it's problematic is that the economy, a K-shaped economy, it's been propped up not by the US consumer as per normal, it's been propped up by that capital expenditure we're seeing from a very select group of names within AI. So at some point that'll burst, we'll stop that capex, the economy will suddenly hit a hard stop and will hurt asset prices, and certain asset prices will suffer very, very dramatically. But we don't have a broad bubble in terms of asset prices. Now, when will that bubble burst? I think we're still a long way off. The way I've been talking about it for the last 6 months is penciling in April next year. That's the first quarter earnings as the first chance where we might see that bubble burst. But it might be much further again. It might be much later in 2026. It might even be a 2027 story. So at the moment, we'll have to watch all the time because it is the most important theme in markets, the AI theme. And it is a capex bubble. It will end horribly at some point. But I think we're still in the inflation stage right now. It's still the stage where it's going to prop up asset prices, not be a risk.
Mark, it used to be that China was that sort of diversification play from the AI trade globally. Now I'm hearing that less and less. It seems like India seems to have taken the limelight from that because we're starting to see some of the macro issues in China really weighing on this market. What's your take on it? I actually prefer China as a diversification in that. I think, if the AI bubble burst at some point, or when it bursts at some point, China will suffer in the short term. But I think that, China's not doing the massive capex in this space. It's not going to suffer as badly. It has the software side. We are going to get a real AI productivity boom. Again, this is where you need to be very selective where the bubble is. The productivity boom that comes through from AI is real. It might be more subtle and steady kind of coming through. China will benefit from that. And at least the Hong Kong stock market is not particularly expensive. Chinese stock market is a little bit more expensive, but the mainland shares. But in Hong Kong, it's not so expensive. You've got the software end users that can benefit from AI. So sure, it's going to get hurt a little bit when the AI capex bubble bursts, but it'll rebound very, very powerfully. Whereas India's stock market, it's not as overpriced as it was maybe a year ago, but it's still expensive, and it will still suffer from a US hit much more directly, and so therefore I actually think China's a much better diversifier for next year. I think again Hong Kong stocks will be an outperformer in 2026. Mark, great to have you. Mark Kuttner there, MLive executive editor, joining us out of Singapore this morning. And now look at what's really dominating news coverage is really what we've been seeing in domestic media in China, right? And it is centered around the economic picture of China and maybe what 2026 might look like. It could be more challenging just given what we saw in that November activity data. And now we're hearing it straight from the top, where President Xi Jinping's call to boost consumption is very much dominating these headlines here a day after we got that data dump. The party's journal, this is Qiu Shi, and other state-run papers have published speeches that Xi made over the past decade on this very subject. And Xi is quoted as saying that boosting domestic demand is a, quote, strategic move. Let's get more now from our China correspondent, Min Lo. She's been parsing through all these pages, right? 10 years of commentary. Tell us about the timing of this release, too.
Yeah, it's interesting. You look at the market moves today and the data down that we got yesterday, and already there are debates among investors and economists. Some are now revising up their expectations for stimulus next year, given how bad the November data was. And it's interesting that state media then published this series of speeches from 2015 until 2025 of President Xi highlighting the importance of boosting domestic demand. And I think it shows you, number one, that China is thinking about this in a very, very long-term perspective, right? China thinks about things in 5 years, 10 years plans. And he also talked about how demand side reforms or demand side management is short-term. Supply side is all about structural and long-term stuff. And that's why China seems very reluctant, because in one of his speeches, he said boosting domestic demand is not just about raising government spending. It's really about, the supply side reforms, boosting private investment, optimizing income distribution, growing the middle class, stabilizing employment. And I think that's a sort of long-term policies we can expect, but not necessarily, things like handouts or short-term boost to domestic demand.
And some of these comments date as soon as what we saw in the economic work conference, right?
That's right.
And he talked about, not chasing this reckless GDP expansion. So they're still focusing on really the quality growth.
That's right. And he is particularly, saying some things that is pretty sharp and saying that China will crack down on these vanity projects that officials like to pursue that could look good on their resumes. And he's saying that an assessment of how well a state official is doing is not just based on its ability to grow short-term GDP. It's about how solid of a foundation they're building for long-term growth, for improving people's livelihoods. And he gave some examples of some wrongdoings, including exhibitions that are seeing disorderly expansion, including fake construction starts, inflated statistics, development zones that are unnecessarily large. And he said China needs to embark on real, genuine growth that is not exaggerated. And he noted the decline in investment that we have been seeing, and is telling officials, stay calm, don't spend on wasteful investment that leads to projects that would be abandoned as soon as they're completed.
Min, it's interesting as well, this reporting we're getting that a rising number of Chinese economists, former PBOC officials as well, are having what would typically be maybe private conversations about where the Chinese yuan should go. They're coming into the public domain. Why is that exactly, and what's going on?
Yeah, certainly it's quite a rare public debate that is fueling speculation about where exactly the yuan will go. And many economists have been strengthening the calls for a stronger yuan for a variety of reasons. They're saying that, number one, it could reduce imported inflation. It could raise purchasing power and leading to this recovery in domestic demand. Number two, it could correct that trade imbalance, given that trade surplus has ballooned up to over $1 trillion. Some are saying that a stronger yuan can attract more foreign direct investment. It could promote the internationalization of the yuan. It could help China escape this middle income trap. But at the same time, you flip the logic. A stronger yuan would also mean if you have, weaker imported inflation, it would be harder to break the deflationary streak, right? So some economists are saying that no, China should not strengthen the yuan. They should end deflation first. And with that, naturally, there will be more demand for the yuan. So it's a bit of a chicken and egg here. But the debate is ongoing, and we're seeing a split here among economists. Some are saying they're expecting the yuan to head below the 7 handle. I think most economists are expecting that. But Morgan Stanley, for one, is expecting the yuan to stay at the 7.05 handle 12 months from now, which is essentially flat from where we are.
All right, Min, thank you, Min Lo, there with a wrap up of what we've been seeing in terms of commentary and the like when it comes to the economy and the renminbi. Coming out, we're talking China Vanke looks to sweeten the terms of a bond delay request after its initial proposal was rejected. We have our Bloomberg opinion columnist, Shuli Ren, coming on. She thinks the default might be better for the developer. We're going to ask her why.
It's Jobs Day, and Bloomberg has the report under surveillance.
How do we understand whether inflation is the bigger problem or whether it's the labor market? That is a key question, and it's going to be challenging.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
We've actually seen the most layoff announcements since 2009.
The weakening is happening, but the overall structure is pretty sound.
The November Jobs Report, today on Bloomberg.
We're taking a look at how the developer Vanke is faring so far in the session. We're actually seeing it moving to the upside here, which is an interesting move just given that broader sell-off we're seeing in mainland equities today and in Hong Kong. But we did actually have that reporting out. So this is sources-based, but what we're hearing from people is that they've actually sweetened the terms of their bond delay request, looking to offer creditors better terms, essentially. So we've got that big bondholder meeting, of course, coming up later this week, Yvonne.
Yeah, so certainly we'll see if we get any sort of update on whether, these bondholders are okay with this sweetened deal here as well. But our Bloomberg opinion columnist Shuli Ren says that might not be the worst outcome for creditors if it does default. She joins us now. So we talked about the sweeteners from this deal. You're saying it's actually better if they actually default. Why?
That's right. So Vanke reportedly is offering about 3% interest payment within the next week. But what is 3% if you're at risk of losing everything? What we're seeing with Vanke is that there is a bit of a creditor-on-creditor crime, like that. The big creditors and the shareholders are in the land-grabbing mode, trying to seize whatever asset that China Vanke still has. So if you're an outside bondholder, right, like you're not the insiders like Shenzhen Metro. If you wait and let Vanke to continue business as usual, by the time the eventual reckoning comes, and they will come, you will have absolutely nothing left. So that's why I think some bondholders prefer that the Vanke go default now, and we go into a court-directed, orderly liquidation winding up process, and then maybe some bondholders can get some money back.
Yeah, and you've really seen, I guess, those changing perceptions around the amount that creditors are expecting to be repaid reflected in the price of bonds, because they've been on certainly a bit of a roller coaster ride over the course of this year. But what exactly has happened here, and what would be the lessons to take away from this as well?
So earlier in the year, Vanke's dollar bonds were trading at 30 cents on the dollar. And then like Shenzhen Metro, which is Vanke's biggest shareholder, but only with 27% stake, they came in to give a series of unsecured shareholder loans. And the bond investors basically took that as an unofficial government-led bailout, except that if it's unofficial, that means there is no real bailout, right? So what happened is that Vanke's bonds were trading near par at 80 cents on the dollar throughout the year until early November, when Shenzhen Metro came out and say, okay, we want Vanke to pledge collaterals on our unsecured shareholder loans. And people suddenly realized that there is no state-led bailout for Vanke.
So wouldn't that trigger a more chilling sort of impact on the rest of the sector? I mean, we have Christy Hong from Bloomberg Intelligence has already talked about the impact of this crisis around Vanke could be even greater than Evergrande or Country Garden because it is quasi-state-backed.
Well, I would like to disagree with Christy here. Basically, what we are seeing is that a lot of the developers that could have gone default already have gone bad, right? And then the leftover, it's like, okay, why would investors think that the Vanke has the state backing? Like Shenzhen Metro only has 27% stake. I just think that credit investors, they need to change their perspective, right? And by the way, China's state-owned enterprises have been going default for at least a decade. Of course, they were much smaller, but you should never expect that even an SOE will never go default.
Shuli, great piece there. Shuli Ren, our Bloomberg opinion columnist. Make sure to check it out. Her column today, It's Better That China Vanke Defaults Now. That is on the terminal and Bloomberg.com. This is Bloomberg.
Taking you now to some live pictures of Anthony Albanese, the Australian Prime Minister, speaking at an event to discuss this event on the weekend, the biggest shooting that we've seen, mass shooting for the country in its history, also the biggest terrorist attack ever. But let's take a listen now.
An immediate and lasting impact on many Australians, but the Jewish community here in Sydney and nationally, first responders and people in Bondi and Sydney, the impact will be particularly acute. The Australian government has made significant investments in mental health support, including expanding Headspace and the creation of Medicare mental health centres. And I encourage all Australians affected by this tragedy to consider accessing the mental health support, including through Beyond Blue on 1300 22 4636, Lifeline on 131114, Kids Helpline on 1800 55 1800. Headspace for children and young people and Medicare mental health centres are of course available to support people affected by this tragedy. Yesterday I convened National Cabinet where National Cabinet again spoke about the scourge of anti-Semitism and the commitment to stamp it out. We also agreed that Premier Minns and Premier Cook, as the incoming chair of the Council of Australia.
You've been listening to the Australian Prime Minister Anthony Albanese there addressing the public, as we said, regarding this mass shooting that took place on Sunday targeting Jews in Sydney's eastern suburbs. As I said, it is the worst mass shooting we've seen since 1996, the biggest terrorist incident ever in the country. And certainly, Yvonne, a lot of anger is really simmering over this, and Anthony Albanese's government is also really grappling with the fallout.
Yeah, yesterday was talking about more about the need for more gun control reforms, and now today maybe talking a little bit more about offering more aid to the Jewish community, given that there was, as you say, backlash from the government here on whether they were able to stamp out the anti-Semitism that's been, really been plaguing the nation. So certainly that's going to be one key focus from the government moving forward here in the face of this tragedy. But yes, Anthony Albanese, the Prime Minister, speaking. We'll give you the latest once we see more headlines coming through. In the meantime, we're going to track what's been going on in Ukraine as well. U.S. negotiators have offered more security guarantees to Kyiv as part of Washington's push to end the war. Let's bring in our news desk as managing editor Jill Deesa. She's with us here right now. So there seems to be a bit more in terms of security guarantees. Is Ukraine likely going to like that?
So at this point, Yvonne, I think there's a couple of things to keep in mind with this latest round of talks here. Trump, of course, saying that now we're closer than ever to reaching a peace deal between Russia and Ukraine. Of course, we've heard that before. I think a couple of really meaningful things here. So essentially, the U.S. is offering Ukraine Article 5-like guarantees, so referring to sort of the NATO construct there. I think it's telling, though, that not only did you hear from one of Zelensky's representatives that, they had some positive progress in these talks, but you also heard from some of the other Europeans who were obviously quite upset several weeks ago when it appeared that the Trump administration had been also negotiating with the Russians. You heard from German Chancellor Merz that they were actually seeing some pretty significant progress with this latest round of talks and talking about these security guarantees. Mm-hmm. Now, of course, it does seem, there's still some things before you actually get over the finish line. Trump did seem to suggest that as part of this deal, Ukraine would still be expected to give up some fairly significant territory in order to make something happen. But I do think the fact that we've gotten this far with these security guarantees, we're getting some initial positive impressions out of the Ukrainians, but also the other Europeans. I think that does indicate that maybe there's some room for more progress here.
Yeah, there is some progress. What are still the key sticking points, though?
I mean, really, I think territorial concerns is really what this comes down to. Obviously, Russia has, for many, many months at this point indicated that they're not willing to budge. Zelensky on the other side also saying that he will not budge. We've heard from Trump repeatedly, including before this, but also, during this latest round of talks, that there is some expectation, at least from some of those, U.S. negotiators, that Ukraine would have to give up something. But that does still appear to be a sticking point. But again, do want to emphasize that at least the initial comments that we're getting here right now do indicate some level of positive progress. Trump thinks they're going to be able to get something over the line by Christmas.
Jill? Thank you, Jill, with that update there on what these negotiations are going and how they're faring right now. Let's take a look at how Chinese markets are doing, because you're starting to see some milestones have been hit here. So correction territory, we are on the sights of that when it comes to MSCI China. We flagged that earlier. HSCEI also in the same sort of radar there. We are also heading 10% down from the October 2nd close there. So we're watching very closely that level. As far as what we're saying, HS Tech, we're also watching, of course, those key levels as well. We could be getting closer, if not 20% of the October 2nd sort of highs here. 6,682 is sort of the level to watch here as well. So that certainly is going to be the case here as we continue on and count down to 2025. This is Bloomberg. .29 a.m. in Tokyo. Japanese markets heading to lunch break in a moment, and I think we all need a breather here given the sell-off that we're seeing across Asia here today. Nikkei 225 is down by 1.25% here. Of course, we're tracking the yen gains as well. We're at 154.89 levels, so breaking below that 155 handle, I should say. As of course, BOJ is happening just days away, and it seems like it's all but guaranteed that they're going to be hiking rates here. I think that Tankan survey, according to Nomura, really kind of means that Japan Inc. is ready for that hike from the central bank there. JGB is not doing a whole lot here this morning, Belle.
Yeah, I like that you say that Asian markets need a bit of a breather. Only Japan's getting that for now, but we've got to wait still a bit more time before we can get Chinese markets also after their lunch break. But going into the end of the morning session, certainly you're seeing quite a lot of weakness across the board. But it is very broad-based selling pressure in the session today. You can see the tech index is the main drag, though, off 1.5% so far. It is as well that the countdown to the jobs data that's coming up later today. The expectation we see payrolls or non-farm payrolls coming in around that 50,000 level. We should see the unemployment rate ticking up, so going back to a level we haven't seen since 2021. And lots of questions around the trajectory for the Fed, but also the trajectory for China going into next year, given you've had that weaker reading on the economic data, but still not that sense of urgency around stimulus.
Yeah, I have to correct myself earlier. The level to watch when it comes to HS Tech is now 5,346. I was talking about the highs there. That was back in October. So that's certainly one to watch. Correction territory for HS Tech, MSCI, China, and the like here this morning. Let's talk a little more about trade because, for now, we're in this trade truce, but certainly we've been tracking, of course, the key metrics of whether things are also looking fragile or actually strengthening. Soybeans certainly has been front and center when we were talking about those talks in Busan, right? And what we're hearing when it comes to soybean futures have slipped of late to the lowest level in more than 6 weeks. And that's really as traders continue to watch for purchases from China to fulfill its pledge to buy 12 million tons of U.S. exports. Now, Goldman Sachs, meanwhile, expects China will need to import fewer soybeans in the future, with the country now at an inflection point for food security as well as self-sufficiency. The author of that report is Trina Chen. She joins us now. She's the bank's co-head of Greater China Equity Research and China Basic Materials and Agriculture Analyst. I want to highlight this beautiful sort of report that you've brought to me today, Trina. Your baby of sorts here on really China's food security and the progress you think that they've made. When it comes to soybeans, though, I think they are the most reliant out of the whole kind of cohort of what you cover, right? They're still about 90% reliant on imports. How do you see that changing, and where are we in this whole sort of inflection point now you mentioned?
Yes, I think soybean is the core of that issues with self-sufficiency. In fact, if you look at all the food group, self-sufficiency in China is 60%. In fact, in the past 2 decades, this number has been consecutively declining, and simply by one driver, that's the protein consumption increase in China. So, but obviously, food security is a national strategy, and food self-sufficiency, if it's not equally, perhaps even more important than the self-sufficiency of energy and China's tech, semiconductor, etc. So we have been also tracking the progress of China's effort in achieving the goal of better self-sufficiency or improving self-sufficiency. And I have to say, I started to cover the sector probably in 2018, but the past 3-4 years, we've seen really remarkable progress, and that's why we put out that report.
So where are you seeing the most sort of progress here, where things are secure, and where are things a little bit more not as secure?
I think overall it's a very holistic approach if you look at that, and it's really coming from all the traditional elements, in which agriculture is a very traditional sector. So you got the land, you got the fertilizer, you have the farming practice, and you have the seeds, etc. Even how you produce animal protein, how much feed do you use for every kilo of pork and chicken. I think the approach is really about productivity and efficiency gain, given there really is not much you could do with the limited land resources. And I have to say the difference in the past 3-4 years is not only China's talking about it, there's a guidance of policy, but we're now seeing a set of very defined solutions, including a lot of the technical details in how to achieve those ongoing productivity gain. And that has been really big changes. And on soybean specifically, it's really about feed conversion ratio, which is essentially your how much feed you need to produce, and that's one of the major part of the soybean demand management. The other one is the content of soybean in feed, we call the total mix ratio. That's actually also being minimized by as much as possible. And also on the demand side, there's a promotion of high quality protein. Which protein has better protein conversion efficiency, and which one actually use the least soybean?
Yeah, it's interesting because you hear about this trade truce, right? And what was part of that agreement was China was going to buy up a lot of soybeans, right? I think they mentioned about 12 million tons this year, 25 million annually for the next 3 years. How do you think this trade discussions is going to square with what you're talking about, this campaign for self-sufficiency?
Yeah. Well, I think we need to be very clear. This is building the capacity of having self-sufficiency. It not necessarily means that China is going to reduce the imports one way or the other, either from the U.S. or the South America. By the way, this is very concentrated itself. It's a very high uncertainty as well. And I think versus where we are, that if you put everything together, you import 100 million tons right now, roughly. You're going to increase actually additional soybean demand because of protein consumption maybe by another 20 million tons.
We're eating more meat now, basically. Yeah.
Exactly. And then with all the effort we're seeing is instead of soybean import going up, we could actually move to 70, 80 million tons because of all these effort within China. But again, this is having a capacity, not necessarily reducing imports.
How then do you look at the investment opportunities in this space? Because as you said, there have been changes that have been made at the upstream level, the midstream, the downstream, all in that effort to try and get the better yield.
I think in the upstream, in terms of seeds, we're seeing the application of biotech seeds and a continued effort in looking for better germplasm. I think essentially that's basically the intrinsic yield improvement. I think we're also seeing in terms of the farming practice, whether it's the agriculture machinery on its own or how they apply what we call the fertigation, basically water, irrigation, and fertilizer together. And a lot of this is actually contributed by or enabled by a very big program we call we call it Big Land Program, but essentially in China it's actually high quality land. Basically, it's building the farming infrastructure actually for 80% of farmland in China. And not only this actually is yield enhancing on its own, but also it become more resistance to extreme weathers. So these are basically some of the approaches from upstream, midstream, all the way to the downstream. And in this report, we have basically laid out in all these factors together. In the most optimistic case, China could actually have the capacity to go back to self-sufficiency.
And are there specific national champions on this level as well? Because which companies essentially are directing this, and is that technology rather being led domestically, or is it technology that's coming from abroad and being applied domestically instead?
It's very domestic. I wouldn't say it's a completely 100% China, but obviously you've seen areas where China develop its own biotech seeds. And one of the national leaders who actually we have been covering is actually DBN, Da Beinong, and they actually hold more than 50% of the market shares in the biotech seeds IP or varieties. So certainly is very well positioned. But broadly speaking, this sector is very fragmented, as it's reflected where it is today in terms of productivity. And we do expect the bigger players to emerge now that a lot of economics start to work on these defined solutions. And I think in this report this time we have also laid out the initiation is a buy on First Tractor, which is traditional tractor company now benefiting from the upsizing larger scale tractors sales, and also Yuntianhua, which is a fertilizer company, phosphate fertilizer company, which actually is now benefiting from the better usage and absorption of fertilizer, and being very uniquely integrated in upstream phosphate rock, which is a raw material become more and more structurally tight in our view because of agriculture and because of EV batteries.
And Syngenta, I mean, they're set to list here as well pretty soon.
Yes.
In terms of the self-sufficiency, you said right now it's about overall 60-some%. How's this going to play out then in terms of where are we going to be about 10 years from now, that number now?
I think if nothing gets done on its own course, this number could go to 50.
Okay.
But with everything we just discussed, we're looking at least 80, if not 94%. So that's based on all the bottom-up solutions that we put together. And I think the difference now, the visibility of achieving that versus 3 years ago, and when I wrote the first of the self-sufficient report, is a lot higher.
Okay. I want to get your take on other basic materials that you cover as well, because given the run that we've seen in copper, in gold prices, what's your outlook for these two for next year?
I think these are two commodities actually in favor in terms of Goldman Sachs global commodities team. We're the team, we like both of them. I think we have to say I've seen the demand has not been very impressive, whether from China or globally. However, I think it's really the supply issue that the disruption that we have been seeing that has being able to keeping the market under very tight balance. And then this morning, I think our colleague in Singapore just issued an upgrade in copper price because the delay of Section 232 U.S. and which will lead to even deeper deficit in the ex-U.S. market. So this is, and then what we observe in China is one of the key questions is, are there actually demand destruction given the higher and higher prices? We've seen patterns of purchasing changes, but I think this round, unlike some of the past cycles, we have actually not seen destruction on the order books, which is so far a good sign. As long as it's slowly edging up, I think that impact is being managed relatively well.
Why do you think there hasn't been demand destruction yet?
I think it's the pace.
Okay.
It's the pace of the pricing. So if you raise your price in a very short period of time, say by 20-30%, you typically get end user in surprise because they would have difficult time to pass it through. This round, we had several, I think, up and down, but now it's sort of slowly edging up. And now we're seeing more acceptance of downstream users on the current copper price.
Fantastic. Trina, thank you so much. Trina Chen there, Goldman Sachs, co-head of Greater China Equity Research and China Basic Materials and Agriculture Analyst as well. We talk too much about self-sufficiency in chips in manufacturing. We don't talk about food security enough, but there you go. A great piece there. And take a look when it comes to the tech space. These are some of the biggest losers on the board on the HS Tech here right now. So SenseTime and XPeng down some 4%. You're also seeing big names like Alibaba also selling off by 3% here this morning. Of course, and we talk about we are in correction territory, or at least approaching that when it comes to MSCI China, when it comes to HSCI, HS Tech, we're all on bear market watch as well. 5,346 is the level. So we're just about 40 points away or so. We're down about 2% for the gauge here right now. Belle, you're watching Korea Zinc.
Yeah, this is actually the biggest laggard for the broader index in Asia today. So you can see a very significant drop there of 17%. But essentially, the company yesterday rose around 7% after it said that it would be planning to build a $7.4 billion critical mineral smelter in the U.S. This is a plan that we know has garnered the backing from the likes of JP Morgan, the U.S. government as well. but there is a management dispute or an ownership dispute at the company that's been going on for several months now between its biggest shareholders, other partners who have launched or had launched an unsolicited takeover bid for the company. So that's certainly getting perhaps in the way of this plan, because we know that that alliance opposes the plan and is planning as well to take legal action. So we've got that in a statement from that came through late yesterday. But again, the market reaction, you can see huge drop there for Korea Zinc. We'll have more ahead. This is Bloomberg. Or watching some rare earth stocks this morning. We are seeing these pretty much under pressure across the board here. It's a bit of a downer story, though, we see for Asian equities. But we are, of course, continuing to track what we're getting in terms of China's restrictions on exports of certain rare earths as well. And the EU, on that point, the EU's top trade official says Beijing started granting longer-term licenses that allow European companies to access critical minerals that are needed for industries, including clean tech, automakers and defence contractors. Speaking exclusively to Bloomberg, Maroš Šefčovič also discussed ongoing negotiations with the US over steel and aluminium tariffs.
What unites us is that we really need to take care of overcapacities which are destroying, the steel production in the US, but also in the EU. And I explain again that we adopted these very far-reaching safeguards if it comes to the imports of steel from the third countries to the EU, which are kind of very much reflecting the measures which US has undertaken several months ago. And therefore, I suggested again, let's go back to the idea where we can kind of build this ring of friends, where we would trade on MFN, or zero levels, and we would have the same, let's say, measures to take on the global overcapacities. The situation as it stays right now is that I sent to Secretary Latnik the list of the codes where we believe that we can definitely lower the tariffs. I understand there is some interest, especially from the machinery sector, but we didn't proceed or haven't proceeded yet to the very concrete negotiations on this type. So we're talking on the level of teams. We are almost, I would say, in permanent contact with my counterparts, and I think this would be good for both sides, because if America wants to reindustrialize, they need machines. We produce the machines. We are ready to send them the machines, but of course we need to find a solution on the derivatives.
And speaking of sort of rare earth minerals, this obviously has been thrust into the sort of the conversation in a very sort of obvious way now by the China. Are we getting closer? Is Europe getting closer to getting a general license from China as the United States has?
Yes, I think that there I can say that we are in very close contacts with Foreign Trade Minister Wang Wentao and also his team, so we are communicating on different levels. We had here the team from China specializing on export controls like a couple of weeks ago, and I think we are getting initial reports from our industry that they are getting these general licenses, but we need to have a little bit more granular information to evaluate the whole process. But the fact that this idea was favorably received, that it seems that we are getting first general licenses, and also that the Chinese side was receptive to our arguments that the process as it was set up in April required too much of I would say, very intrusive information, too many photographs, too much detail about the supply chains, and I think that the general licensing could be one of the solutions how to address this issue.
That was the European Commissioner for Trade there, speaking with Bloomberg's Oliver Crook. And if you're a subscriber and you want to rewatch that interview, you can via our interactive TV function, that's TV Go. You can also become part of the conversation by sending us instant messages. So do check it out at TV Go. This is Bloomberg.
Now, Ford will take a $19.5 billion in charges tied to a sweeping overhaul of its EV business after struggling for years to make it profitable. Speaking with Bloomberg, the CEO, Jim Farley, says the automaker can hold its ground against low-cost Chinese rivals.
To make that business profitable, we have to get to a BYD cost. And so this skunkworks project called the Universal Electric Vehicle that we're making in Kentucky, that is designed to match the BYD cost in like a Mexico. And we really believe we have that delivered. We've sourced all the parts now. We're testing prototypes. We're starting to run the production line. And so we have real confidence that we can do that. And that's why we're telling people that we think we'll be profitable. We've worked hard for the last couple of years on this EV project, and we have fully competitive costs with the Chinese. Now it's our chance to bring a pickup truck with that low-cost EV to Americans. We think it's going to be a big hit.
Hey, I want to ask about the Chinese because while I love it when companies go back to steel and V8s and stick shifts and handbrakes, obviously many people are betting the future is on EVs, autonomous vehicles, and the Chinese are certainly making real strides there. As you make this pivot back to sort of the classic American pickup truck, what will you do to keep up with the Chinese as they continue to make strides forward?
Make no mistake. Our strategy as a company is to give people choice. Part of that choice is to have fully competitive costs with BYD localized in North America. Matt, we are going to have a fully competitive BYD EV built here in America for Americans that we believe are going to be profitable. And to do that, we had to massively innovate, bring LFP to the United States, reduce the manufacturing content of the vehicle radically, redesign the whole assembly process, engineer the vehicle with all new suppliers. It's a whole different approach on the whole engineering of that vehicle. We are here to compete globally. We're not going to cede our future to the Chinese. And we're the most American car company, but even for us as the most American car company, we're a global company. And that UEV product is the heart and soul of our competitiveness for the future. But the Chinese don't know the truck customers like we do. And we know customers want E-Revs and they want hybrids and they want Raptors like you have. It's a diversity of all that lineup that makes sense for us to compete and win against them.
That was the Ford CEO, Jim Farley, there speaking with Bloomberg's Matt Miller and taking a quick check on markets here because it's really that story around China stocks, Yvonne, and what we're seeing as well across broader markets today because you've got the Nikkei that's actually gone into its lunch break here, but it was down 1.3% going into the end of the morning session here. Lots of focus as well around the BOJ meeting coming up later this week, but those key levels we're tracking intraday, you're already in correction territory for the MSCI China index, for instance. You're getting very close for the HSCEI, HS Tech as well, just a few points away.
Yeah, it might be just profit taking, but really it comes down to what this November jobs reports could look like coming out of the U.S. later on today. So maybe people are just not making bold moves right now. Maybe just take some chips off the table here, given just this is pretty high profile economic data, right? And really could it dictate what the Fed discussion is going to look like and whether they can continue with rate cuts next year. That still seems to be the lingering debate here. And so, yeah, you are seeing right now significant when it comes to just it's a pullback across the region everywhere you see when it comes to Kospi, Taipei, AXX 200 looking a little bit more resilient in the face of it right now. U.S. futures are lower by about 0.5%. That's it for us here on the China Show. Insight with Haslina Amin is next. Stay with us.